Welcome to the Capital News. I am your host, Alex Karitis. Today is October 2nd, 2019. Thank you so much for joining me. So another volatile day on Wall Street, and again, to the downside. So again, kudos to our volatility model in a timely podcast yesterday where we updated that model and walked through it once again, which we have been doing here over the past several months. The genius is its simplicity. Keep it simple, stupid. That's what we talk about here. And that volatility model doesn't get much simpler than that. And it is holding water. And what we said yesterday was that volatility, if this model continues to hold water, is projecting, it is forecasting almost a repeat of the fourth quarter of last year. However, it could be to the downside, which would be a repeat of last year, or it could be to the upside. There could be some sort of magnificent rally that comes out of nowhere. I think if there is the upside movement, it's going to be predicated on a couple of things. First and foremost, some sort of a deal of substance. And I stress the word substance. There has to be substance behind the deal between the United States and China. I find this highly unlikely, and I'm going to explain the reasons why here shortly. Secondarily would be the Federal Reserve coming to the quote-unquote rescue once again, but this time they're going to have to go all out, which I don't anticipate that they're going to do. So to me, the likelihood of those events, that there's going to be a substantial and substantive deal between the United States and China is unlikely. And the fact that I just don't see right now the Federal Reserve coming to the rescue in any sort of dramatic form. And what I mean by dramatic form is coming out and cutting interest rates, perhaps not by 25 basis points, which is being priced in right now by the markets, but by 50 basis points. And that's not enough. They're going to have to come out and admit that they're going to have to restart QE4. And if you look at the current balance sheet of the Federal Reserve, they're already starting to expand their balance sheet, which is quantitative easing, because that's how that is transmitted. Now, they're not telling you this, but you have to go and you have to find this data, and it's available on their own website. And it's easy to find, but they're not going to come out and admit this. And, of course, they're not going to call this QE4, at least not now. Maybe they will at the end of the month during their policy meeting. Maybe they'll come out and say, yeah, we got to start QE4 this time. I think they're going to come up with another name. Or they're just going to say that this isn't an emergency monetary measure. This is the new normal. This is just a tool that we have in our toolbox, and we're going to use it. Plain and simple. Now, it's not plain and simple, because for all intents and purposes, the Federal Reserve, along with many other central banks around the world, are pushing on a string. They are starting to inject liquidity back into the markets. They are lowering interest rates, especially the major central banks, the Federal Reserve, the ECB, the Bank of Japan, Reserve Bank of Australia did it earlier this week. We anticipate that the Reserve Bank of India is going to continue cutting interest rates, and their meeting is taking place on Thursday. We anticipate that the Bank of England will cut interest rates as well. And the Canadians are likely to follow suit, because who wants to be left behind? Oh, and don't forget our friends and buddies down there in New Zealand. They continue to cut interest rates, although they have shied away from saying we might not use unconventional methods. Well, all right, I'm not buying that, but that's what they're saying. Before, a couple weeks ago, it was, you know what, we might use unconventional methods, that being quantitative easing or perhaps even negative interest rates. Now they're stepping back from that. Now, time will tell, but I anticipate that they will go to those unconventional methods in New Zealand as well. And don't forget the People's Bank of China. Now, they're sort of taking a nap right now because they're celebrating their 70th birthday, but they will be alive and well next week. The markets are on pause, but they will be alive and well next week. And remember, it's October 10th is when the Chinese trade delegation is scheduled to be back in Washington, D.C. to continue those high-level talks. Now, some other news that we're going to talk about here. Well, first, before we get really going here, some political news. I'm sure many of you are aware by now that Democratic presidential contender Bernie Sanders had some emergency heart procedure this morning. Had a couple stents put in. We wish him well. We wish nobody ill will here. We don't agree with Bernie on a lot of things, but we admire Bernie's enthusiasm and passion. And I don't think that Bernie Sanders is an enemy of the country, although a lot of the policies would go against what this country stands for. But I do believe that he does have good intentions. Not that means that it's going to prove to be successful, as we know. But we wish him well. If you pay attention to some of the pretty much the sports betting, if you will, on who's likely to get the nomination, right now it's a runaway with Elizabeth Warren because of this event with Bernie. People are going to say, well, Bernie's up there in age. We were going to look the other way on that, but now he has a health scare. Can we trust this? That's going to put some pause into a lot of people. And with the shenanigans that are going on right now with this impeachment inquiry, Donald Trump and his defenders pointing the finger at Vice President Joe Biden, his odds of getting the nomination are deteriorating as well. So right now, this is Elizabeth Warren's to lose. And I have to admit a miscalculation on my part with Elizabeth Warren, because earlier on, months ago, we said, all intents and purposes, what happened with her claiming Native American heritage and the Pocahontas stuff, that we figured that was pretty much it for her. There was no way that people were going to look at her and take her seriously. But now, with such a weak field on the Democratic side, and with that health scare with Bernie, and with these shenanigans with this impeachment inquiry, and now these accusations of corruption with Joe Biden, that's starting to hurt him as well. And so who's left standing but Elizabeth Warren, who, again, to her credit, and I've mentioned this many times before, given her performance on these debates, she has stood out. She has held her ground. And while I don't agree with her on virtually anything, she does have ideas. They're not good ones, but she does have ideas, and that sort of is a differentiating factor between her and the other candidates. So it's going to be interesting to see how Elizabeth Warren can handle this and if she can stay in that front position. So we'll see. But again, best to Bernie. Now to the markets. The S&P gave back 53 points, a loss of 1.8%. The Dow Jones Industrial Average gave back 494, a loss of 1.9%. The Nasdaq lost 123, a decline of 1.6%. And the Russell 2000, the small cap index, gave back 14, a loss of 0.9%. The Dow Jones Transports lost 2.3%. The Dow Jones Transports is now trading below 10,000. This is a level basically giving back 1 month's worth of gains over the past couple of days. So that is a big sell-off. The New York Stock Exchange also gave back 1.8%. Oil trading lower on growth fears. WTI is at $52.80. Brent, the international metric, is at $57.90. Gold, as of the time of this podcast, is trading at $1,501 an ounce, so back above $1,500, albeit very slightly. It nevertheless gained that technical level. Once again, we said to be mindful of $1,500 an ounce. It is right there again. Silver, also catching another bid, a flight to safety. It is trading at $17.60 an ounce. Continuing with the flight to safety, the U.S. 10-year Treasury yield gave back 3 percentage points and is now yielding 1.6%. So we got a flight to safety. We got growth scare fears again, and we're going to talk about that because the title of today's podcast is Auto Sales Driving Us Off a Cliff, and we're going to get to that data here shortly. The VIX, the volatility index, gained 11% and is now trading at $20.56. Continuing with some of our analysis on FedEx, it continued its decline and lost an additional 0.6%. And U.S. Steel, ready for this, gave back 8.3%. It is now trading below $11 a share. And for those of you who may just be joining us for the first time, given U.S. Steel, since the trade tariffs have been placed, since these steel tariffs have been put on place, we have U.S. Steel losing over 70% of its market value. I highly doubt that U.S. Steel and Company think that that is winning, to quote Donald Trump. But who knows? Maybe they think they are winning, but I doubt it. Some other news that is sort of rattling markets, in addition to the auto sales figures that came out, is the ADP employment figures. Now, I don't give a lot of weight to the ADP employment figures. I've stated this on previous podcasts, but that number was released today, and that was weaker than anticipated as well. So again, another headline risk to the downside for the market. So that was just something to continue the downward pressure. We will get the government's official figure out this Friday. Now, of course, we know there's going to be revisions, so that's really what we have to pay attention to. What were the revisions for the prior months? Because if these are revising downward, then, ladies and gentlemen, this is another signal that we have reached the peak of this historic business expansion, okay, in this business cycle. This is the longest expansion in U.S. history. So if we continue to see downward revisions in the jobs report on Friday from the last few months, that is an indicator to me that this economy is rolling over, that we have reached the peak. And when you reach the peak, where do you go? Down. That's called a recession. Okay, so buckle up. So we're going to have to pay close attention to that number that comes out Friday. And there's also some political jockeying that's going to be with it too, because look what you got coming up. We got the trade negotiations. And if you continue to have this deterioration, that's not going to bode well for any type of leverage that the United States has, at least on the headline news. So we're going to have to pay close attention to that. In addition, Tariff Man gets another tariff. $7.5 billion is going to be levied against EU goods. This is on the back of a WTO ruling that is given favor to the United States, and now in retaliation, Tariff Man gets to slap $7.5 billion worth of tariffs on the European Union. Okay, they're going to go after everything. Some of you may have caught this in the news the other day. Secretary of State Mike Pompeo was over in Italy, and a reporter got up and gave him a block of cheese, or a wedge of cheese, because obviously she was being sarcastic and saying, look, you guys are about to put tariffs on this cheese. Come on, get real. But nevertheless, that's what happened. That was sort of a little bit of a comedic relief, but the Prime Minister of Italy wasn't having it. He wasn't too fond of that move. But Tariff Man gets some more tariffs. So like we've been saying here, even if there is a deal with China, which again is highly unlikely, he has been saying that the EU, the European Union, rips us off worse than China does. So how can he let them skate? He can't. He's going to have to go after them in some form or another. So even if there's a deal, all right, now it's on to the next prey, and that's going to be the European Union. Not good, folks. I'm just telling you. And the reason I'm saying that Donald Trump, that I don't think that there's going to be a trade deal now, is because we said yesterday one of two things was going to happen. Donald Trump and the White House were either going to come out and say that the trade talks were going fantastically well, and we look forward to having these high-level trade negotiations next week, or Donald Trump was going to come out and start blaming the Democrats for being the do-nothing Democrats, which he's already doing, and just saying that they're not getting anything done. And he has blamed the Democrats for this recent market sell-off because nothing's getting done. So we told you this was going to happen. It was one of the two. It was a coin toss. Well, that's the one that played out. Donald Trump now has an excuse. He's going to blame the Democrats. I can't get anything done. These people want to impeach me from day one. We have USMCA, we have drug prices, we have infrastructure, we have immigration policy, we have national security issues. We have a whole host of things that need to be done to better this country, and the Democrats just want to impeach me. So if the markets go down, that's why he's going to blame it on them. He will continue to blame the Federal Reserve, which he did yesterday as well, because of all of the PMI numbers that are also rolling over and showing contraction. He's not going to take responsibility or saying that he is any part of it with this trade war, not any part of it whatsoever, or by going further into debt, $1 trillion deficit. Now that's a joint venture there between the administration and Congress, but nevertheless, nobody's talking about it. Nobody's making it better. In fact, they're making it worse. And we are not officially in recession. So when that happens, these deficits are going to be $1.5 trillion, $2 trillion, maybe even more. So, we're at $23 trillion right now on a national debt ticket. Just wait. Just wait how quickly that goes up. And for what? Absolutely nothing. We're going to have all of this debt and nothing to show for it at all, just as what we have today. All of this debt and nothing to show for it. So, Donald Trump has the excuse. He's going to continue to blame the Democrats because he can. And they're giving him a lot of ammunition to do it. And I think right now this is what actually pisses this president off, and I think it encourages him to dig in deeper and to really want to win the election in 2020. This is the type of stuff, this is, Donald Trump whether the man in reality or the caricature that's out there, the myth of Donald Trump, whatever, that this is the guy that punches back and fights back and wants to dig in. Well, this is it. I mean, his presidency is on the line here, and he is digging in. He continues to attack the media. He continues to attack Nancy Pelosi, Chuck Schumer, Adam Schiff, and other members of these committees that continue to investigate him. He continues to go after the whistleblower, which I don't think is a smart move politically, but he's doing it nonetheless, and a whole host of other things. So he's digging in, and the Democrats have given this to him on a golden platter because we knew Donald Trump wasn't going to take responsibility for any of the negative news anyway. But now he has a legitimate excuse that people are going to buy. Now, again, we're fine when he goes after the Federal Reserve from the standpoint of blaming them, but calling for lower interest rates, negative interest rates, and quantitative easing is not the solution. In fact, that's the problem. That's why we have these issues in the auto market. It's why we have so much debt that's in the system, that the households, corporations, governments themselves are over-leveraged. They're oversaturated. They can't breathe. Central bankers are trapped. Okay, this is of their own doing. So it's fine to blame the Fed, but he's not doing a very good educational campaign to explain to people why he's blaming them. He just says, well, they're poor communicators. They're not listening to me. But that ain't good enough. That ain't good enough. You got to educate the people, and he has the platform to do it. So shame on him for doing this the way he does. But nevertheless, he's got the Fed, he's got the Democrats, and if he wants to blame China, he can blame China because that'll be coming up as well. And a lot of people will buy that. Now to some of the auto news, okay? This is not good news to start the month of September, but 1 month does not make a trend. But nevertheless, this is something worth noting because this is further evidence that there are big cracks in this foundation, all right? So we have Toyota. Year-over-year change for September, down 16.5%. They missed market expectations of 11.9%. So they were down 16.5%. Honda, year-over-year change, negative 14.1%. Missing market expectations of negative 4.6. Not even close. Not even in the same ballpark. Nissan, negative 17.6% year-over-year change. They actually beat market expectations because the market thought they were going to do even worse. The market thought they were going to lose negative 20.8%. So Nissan, they were down 17.6%, but they beat expectations. Not good, folks. The severity, this is an article from Bloomberg. The severity of the slide stokes fears that a long-anticipated car sales collapse may be arriving. The slowdown puts auto dealers already struggling with shrinking profit margins in an even more precarious position. With outgoing model year vehicles clogging their lots, automakers had to pony up record incentives of more than $4,100 a vehicle in the third quarter, according to researchers at J.D. Power and LMC Automotive. Shrinking profit margins, folks. What have we been telling you here for months? Nobody wants to listen. I've been saying we've had peak profit margins here for a while. And guess what? We have the Americans, we have automakers, we have GM was lower than expectations, but still to the positive. And you also have Ford and Fiat who did beat expectations. So a couple good things there for some of the American players. However, it wasn't that long ago where some of the junk from Ford was downgraded. I'm sorry, some of the debt of Ford was downgraded to junk status. So that's not good for Ford Motors either. Okay, and when you have shrinking profit margins, what starts to happen after that? You start to lay people off. So when you have GM, General Motors right now, who continues to be in negotiations with the UAW, what do you think those auto workers are going to want? Do you think they're going to want lower pay and fewer benefits? No, they're going to negotiate, and they're only going to sign something if they get higher pay and better benefits. So guess what that's going to do to GM's bottom line? It's going to squeeze their margins. So guess what's going to happen? They're going to start laying people off. So the very people who are trying to negotiate a better deal for their employees, for their workers, are going to end up laid off because the profit margins are going to start getting squeezed at GM. And when you got these sales lots getting backfilled with older models, what do you think is going to happen? They're going to shut down these lines, which they're already in the midst of doing. So not good, folks. Not good at all. But this is entirely predictable, and this is what we've been talking about here for months, and now it is finally starting to come to fruition. It's just not good. Subaru's incredible run ends. It nearly lasted the length of a two-term U.S. presidency, but Subaru Corp's streak of monthly sales increases is over. The Japanese carmaker's run ended in September after 93 months, almost 8 years. Deliveries dropped 9.4% for Subaru. So again, folks, not great figures here from the auto sector. And just for the sake of talking about some models, obviously we have the volatility model, which we do, like we said at the top of the podcast, is surprisingly simple and highly effective and accurate thus far. And we continue to monitor it, and we continue to have podcasts that are devoted in large part to the volatility model. But we have other more complex models, and some of the key drivers that we look at in determining how the stock market may perform is predicated on the strength of the auto sector. And if we have an auto sector that is turning south, it will bring the market down with it. Believe me when I tell you, there are hundreds of thousands of jobs at stake directly, and hundreds of thousands, if not millions of jobs affected indirectly. I mean, think about all of the steel, the aluminum, the glass, the rubber, all of the technologies, the circuit boards, everything that's in there. These things are computers now. I mean, this industry is imperative to this country. Look at Germany, for example. They're going into recession. They're not selling any cars. They're shutting down. That's how imperative that this is to economies. And when you see a slowdown in the auto sector, when you see a slowdown that is continuing in the construction sector, when you continue to see commercial real estate starting to come down, when you start to see high-end residential real estate starting to slow down, this is what happens, people. These are huge segments of this economy. And you tie that all together with all of the PMI data that we have been discussing here over the past couple of weeks as it has been reported. It's recession. It's the peak of the business cycle right now. This expansion is peaking. This is larger than Donald Trump. It was larger than Barack Obama. It's larger than all of us. So I'm not here to pick on Donald Trump. The business cycle, the economy is bigger and greater than all of us, as it should be. Nobody should be pulling the levers of this economy, despite the fact that federal governments try, that administrations try, that the central banks try. And to some degree, they have a lot of sway on it, which we are totally against here. We're for free market capitalism. You don't have free market capitalism if you have counterfeit money being printed at will by central bankers who think they know what they're doing when they clearly don't. So wake up. End the Federal Reserve and abolish the federal income tax. Then you'll start to solve problems. Starving the beast. I mean, you got to get real. That's what you have to start doing. So that's some of the news out there. The other thing that sort of gets me going here with the auto sales and the auto sector in general is the fact that we continue to see higher car prices. And if we had a well-functioning market, these prices would start to come down. But instead of these prices coming down, you know what they came up with, folks? They came up with car loans that are 7 years long, that are now 8 years long, maybe even going to 9 years long to buy a car. Are you kidding me? This is what people are doing. We talk about this here all the time, too. It's not the payment. It's the asset that you have to pay attention to. People say, well, that's an expensive vehicle, but it's real nice and I really want it. But what would be the payment on it if I wanted to take out a 3-year loan? Oh, it'd be about $700-800. Oh, no, I can't do that. Well, what happens if we take that out to 5 years? Well, maybe $600. What do we do if we do 7-8 years? Oh, well, we can get that sucker down to $400 a month, maybe. Oh, I'll take it. People don't understand. They have no financial education. None. Because they want to drive something nice. Because they're looking at the payment and not the price of the asset. They don't understand amortization. They don't understand that by the time they're done with that vehicle, it's going to be negative equity. And if you look at the share of negative equity vehicles, it's like at an all-time high, or a multi-year high. It's been multiple years since it's been this high. This is not good. And somehow we're supposed to believe that the last remaining pillar in this economy that we are clinging all hope on is the U.S. consumer. There is over $1 trillion in auto loan debt now. This dwarfs where it was pre-Great Recession. It dwarfs it. Just like student loan debt is at $1.5 trillion. That dwarfs where it was 10 years ago. 10 years ago, it was like $500 billion. Now, we've tacked on $1 billion in student loan debt like it's nothing over the past decade. Same thing with autos. Credit card debt's back up there. And we're supposed to cling all hope to the U.S. consumer? Are you kidding me? Or because we're going to get some sort of miraculous trade deal with China? Let me tell you something, folks. If it was so simple for central banks just to cut interest rates and print money, and for politicians to get together and sign their names on some fancy pieces of paper, and you would dodge a recession or a slowdown, we would never have a slowdown or a recession. Wake up, start thinking, and start preparing yourself for what's coming, because it ain't going to be pretty. Could there be a last gasp for air in some sort of a melt-up? Yeah, there could be. It's possible. But will it be long-lasting? No, it won't. That would be very akin to 1998, 1999 with the dot-com bubble and what happened afterwards. You got your high, you got your fix, and then everything came down 80%. So you want to go up another 20% just to come down 80? You think you're smart enough to time it? I highly doubt that you are. Nobody's going to come out and tell you this stuff. There is no leadership. They're going to continue doing what they've been doing, which is causing this problem, pushing people further out onto the risk curve, but they don't care. They don't care because they're not going to admit that they've made a mistake. They're not going to do it. Now, in addition to the U.S. markets, we have the Nikkei, the Japanese markets, down 2% today. We have the British markets suffering their worst loss in, I think, 3.5 years. They are down 3.23% on the day. That's the British markets, the FTSE 100. We have the German markets down 2.8%. We have the French markets down over 3%. And we have the Spanish markets down 2.8%. And at the time of this podcast, because we do these later in the evening, same thing, because Japan is trading live right now, so are the Australians, and they are down 2.28%. No, this could just be a one-off. This could just be a little bit of a relief. There has been, a rally to the upside since that consolidation that we experienced during the month of August and a little bit through September. So maybe this is just a breather. Maybe this is the time to buy the dip. I don't think so. Because the only thing that's really going to turn this thing around is, again, a trade deal, which I'm just not going to buy it. I just don't think it's going to be of any significance. I mean, soybeans ain't going to save the day. Just not going to do it. It'll be short-lived. Buy the rumor, sell the fact. Because once people start to dissect it, I mean, are you going to trust the Chinese to maintain this deal? I'm not. I don't even know if I'm going to trust the president to stick to it. Because even if he does, is he going to start going after the EU next? How could he not? He's been threatening them for a long time too, but he wants to handle one thing at a time. He's going after China. That's the big dog right now. He's got a preliminary agreement with Prime Minister Abe right now of Japan. Okay. Markets don't really seem to care about that one. China's the big dog. They will be here next week. We will keep you posted. I may not be doing a podcast for the next couple of days, but I intend to have one out on Sunday evening for the week ahead segment. Although, depending on what news breaks, I may have to do a podcast tomorrow or Friday as well. But be mindful of Friday's jobs report. That is going to be big news. So if this market is going to find fresh air and maybe catch its legs, it'll be based off of that jobs report. If that jobs number continues to vindicate all of the other data that we have been seeing, then we are going to continue likely to see a sell-off into Friday and into this weekend. So if I do not speak with you guys over the next couple of days, enjoy your weekend. Stay diversified, stay vigilant, and stay with the Kapital News. Thank you so much for joining me. Please like, share, subscribe, get the word out, and leave your comments. We do love hearing from you. This is the Kapital News. I am Alex Karitis. Godspeed.